School's back in session, Halloween's around the corner, and for longtime investors, they know fall can often be a scary time. This week, I'm going to cover some questions and some things that we see with regularity that investors really should be focusing on that could create spooks down the road. So lots of questions come in. I'm, again, not just talking from clients, friends, people you interact with. As soon as they find out what the day job is, they've got some questions to ask. And what we find as we talk to prospective clients, or again, even just people in regular conversation, is how often they're not focused on the right things, or what they think they should be afraid of isn't really all that scary in our opinion, but they have these other issues that are huge. So what types of things am I talking about? Well, we tend to, as investors, get scared by things we clearly don't understand, can't control, right? Right now, that's Federal Reserve rates, the trade conflict with China, geopolitical events dominate so much time and attention for investors, and they can get very reactionary and emotional around that, which again leads them into attempting to time markets, which again leads to underperformance over time for them. Meanwhile, what we see, whether it's sitting down with new 401k participants that have transferred into a plan we run, or sitting down with prospective clients, is how often investors don't really know what they're invested in. They'll say something to us to the effect of, well, I think I'm in a conservative portfolio, or I think I'm in an aggressive portfolio, and they're in the opposite. Happens all the time. They don't understand the difference between volatility and risk. Or for those, maybe they do know what they're in, and in this case, I'm thinking more of equity-heavy investors, but they're so busy trying to catch every bit of upside that they can, that consciously or subconsciously, they understand that they've entered into this game of musical chairs, which has its own timing element clearly, that could end at any point in time and catch them off sides to their detriment. All of this is unnecessary, all of it's avoidable, and of course in the case of knowing what you own, it's vitally important that you have at least a base understanding of what you want to have. So I wanted to break down some questions that, whether you're a client of ours, I hope you know the answer to these if you're a client of ours, but we can always take you deeper. And if you're not, that you can, and we're happy to help, again, give that second opinion from, or perhaps show you something that you haven't seen before by way of what's really going on within your portfolio. Number one is, again, what do you own? I did a series just about this time last year around this concept of what do you own? And then number two, why do you own it? So oftentimes we see people who think an aspect of their portfolio is working or broken, and it isn't the thing that's working or broken. It's just that the market may be giving them or not giving them what they want in that moment in time. Short-term performance needs, or what has or hasn't happened, can't be why you own something. Of course, we all invest to make money over time, but the real question again is, what is it supposed to be doing in your portfolio? And relative for whatever that is it performing as it should? Now that might not look great. It could be fantastic, but don't let recent market performance trick you into thinking you do or don't need to do something within that portfolio with respect to allocation. What we do see, again, in terms of what's really lurking within investors' mindsets, are some of those subconscious questions, again, that are there that we'd like to pull to the forefront. I'll read off a couple that I phrased up. One, if I am so fearful as an investor of market declines, why do I have so many equities within my allocation? This kind of gets back to that musical chairs phenomenon. If you're someone who feels either financially or emotionally you can't take a lot of risk, we all have upside tolerance. We will take as much as we can get, but not everybody has a lot of downside tolerance. Again, whether that's emotionally, they just can't withstand it without feeling the need to get out, or financially, they can't take those large types of drawdowns if they're in the distribution phase of their lives. To that end then, for those in the distribution phase, they really need to think through, again, not whether you like the gains that stocks are going to provide, quite clearly that you're going to, but can you and your plan, again, we touched on this in the written part of last week's commentary a couple weeks back, withstand things emotionally and financially. Have things matched up from a risk perspective, that you'll give them the time that they need to actually work. And can your financial plan withstand the inevitable drawdowns and market volatility that are part of being an investor? Those parts aren't avoidable, but the right allocation can be. So again, that's why from an emotional perspective, we work so much with clients, showing them different drawdown charts of how their portfolio is performing in advance when we're looking at allocations, look at some different hypothetical drawdowns to really quantify that risk perspective, not just in terms of percentages, but do you want to go home and tell your spouse the portfolio is down $1 million? I mean, for most people, the answer is no. That's going to create some type of reaction that, again, wouldn't be healthy. But then also from the financial perspective, do you have that commensurate amount of income? Do you have proper diversification? And that may mean you've got something that isn't super exciting within your portfolio, but it's going to be there in that moment of truth when you need it. Again, a properly diversified portfolio, by definition, means things in your portfolio are going to act differently in the same type of economic conditions. That means they're not correlated. So your bonds might not keep up, or your stocks might not be keeping up, or international versus domestic. All of those things go into it, but they're important from a long-term portfolio allocation perspective. In conclusion, what does this mean for us and our process? For those people who embrace it, who really understand why we're doing what we're doing, why we own what we own. And of course, there are questions and people call in. We hear time and time again, man, I am not one of those people who has to race in to see what happened in the stock market that day, like so many of my friends or family. I get how the plan's designed to work. I get where I need to put my attention. And what that means is you don't have to be a person who's caught up in the fantasy of trying to capture all the upside of what's hot and get out before the downside comes. That again, after 20 plus years of doing this, I can tell you brings nothing but angst and frustration when it really matters. With that, thank you for tuning in. Feel free to reach out with questions, whether you're a client or not. We look forward to being of help.